August 15th, 1971, a Sunday night. President Nixon appeared on American television and, in 11 minutes, dismantled the economic architecture that had built the middle class. He called it a temporary measure. It has now lasted 54 years. What happened that night, the severing of the dollar from gold, didn't make workers poorer immediately. It did something more precise than that. It rewired the order in which prosperity flows. And it guaranteed that the people who do the actual work of an economy would always receive their share last after the value had already been extracted. This is the history of that mechanism, and of the class it has been slowly consuming ever since. Act 1, the promise and the break. Between 1948 and 1973, the American economy ran on a simple and verifiable contract. For every percentage point that worker productivity climbed, wages climbed with it. The Economic Policy Institute has documented this in exhaustive detail. Over those 25 years, productivity rose 96.7%. Median hourly compensation rose 91.3%, nearly a perfect match. This was not an accident of history. It was the consequence of deliberate architecture. Progressive taxation, strong unionization rates, a regulated financial system, and a currency anchored to something that couldn't be conjured at will. Then, in 1973, the lines diverged. Between 1979 and 2022, productivity in the American economy grew by 64.6%. In a functioning system, by the logic that textbooks published before 1975 would have confidently predicted, wages should have followed. They rose 17.3%. The gap between those two numbers is not an economic mystery. It is a ledger. And somewhere on the other side of that ledger, that missing 47 points of prosperity is recorded as a gain. Act 2, the Cantillon trap. In 1730, an Irish-French banker named Richard Cantillon published an observation so precise it reads less like 18th century economic theory and more like a manual for the system we inhabit today. His insight was this: when new money enters an economy, it does not distribute itself evenly. It flows. The first recipients, those closest to the point of creation, receive it before prices have adjusted. They buy assets at yesterday's prices. They accumulate. By the time the money reaches the final recipients, the salaried workers, the savers, the people whose income arrives on a fixed schedule, prices have already moved. The workers receive the money. They pay the inflation. The gain belongs to someone else. Cantillon described this as a structural feature of monetary systems, not a flaw, not a conspiracy, a feature. Between 2009 and 2020, the Federal Reserve expanded its balance sheet from $900 billion to $7 trillion. That money did not arrive in worker paychecks. It flowed into the banking system first, then into financial assets, then into real estate. The S&P 500 tripled. Housing prices in cities like Denver and Seattle climbed 80 to 120%. The Federal Reserve's own survey of consumer finances supplies the crucial detail. The top 10% of American households own approximately 87% of all stocks and mutual funds. The bottom 50% own less than 1%. This means that when quantitative easing pumps trillions into asset valuations, 87 cents of every dollar in gains flows to households that were already wealthy. The middle class, which holds its wealth primarily in home equity and labor, receives a diluted fraction of the upside and the full weight of the downstream inflation. This is not redistribution through malice. It is redistribution through architecture. And the architecture was not built by accident. Act 3, the historical parallel. There's a period in British economic history that economists call the Engels pause. Between 1780 and 1840, the Industrial Revolution produced one of the most dramatic surges in productive capacity in recorded history. British industrial output doubled, then doubled again. Factory owners accumulated fortunes at a scale the country had never seen. Real wages for ordinary English laborers declined. Friedrich Engels documented this in 1845, not as a paradox, but as a predictable outcome of who controlled the productive apparatus and who merely operated it. Production was soaring. Workers were not sharing in it. The gains were real. They were being captured elsewhere. Economists eventually named this the Engels pause because it ended when political pressure, labor organization, and legislative reform forced a rebalancing. The United States is living through a second Engels pause. The productive capacity is real. The technology gains are real. The economic output is real. The question, as it was in Manchester in 1835, is not whether the wealth exists. It is who is positioned to receive it. Act 4. The three pillars. Repriced. The middle class was never an abstraction. It was defined by three specific economic achievements that separated it from poverty: home ownership, healthcare access, and the ability to purchase education for the next generation. All three have been repriced. In 1970, the median American home cost approximately 2.2 times the median annual household income. The math was hard. It was not impossible. By 2024, that ratio stood at 5.6 nationally. In coastal markets, it exceeded 10 to 1. With mortgage rates climbing above 7% through 2023 and 2024, the monthly payment on a median-priced home reached the highest level in recorded American history as a share of income. For the first time since the 1930s, renting has become cheaper than owning across most major U.S. markets. Healthcare followed a parallel trajectory. A 2024 Kaiser Family Foundation report documented the average annual premium for employer-sponsored family coverage at $23,968, with the employee's direct share at $6,296. For a household earning $75,000 annually, that represents 8.4% of gross income before a single medical service is rendered. In 1960, healthcare consumed 5% of American GDP. Today, it consumes 18%. The additional 13 percentage points were extracted from somewhere. The wage data suggests where. Education completes the picture. In 1980, 4 years at a public university cost approximately $10,000 in current dollars. By 2024, the figure exceeded $100,000. Over the same period, the college wage premium, the income advantage a degree confers, grew from roughly $7,000 per year to over $30,000. The credential became simultaneously more financially necessary and 10 times more expensive to obtain. Act 5. The debt substitution. When wages stopped tracking productivity in the late 1970s, the economy did not contract. It adapted. The adaptation was credit. From 1945 to 1975, total consumer debt hovered around 40% of disposable personal income. Borrowing was an accelerant on real earnings. It helped families move faster toward goals they were already approaching. By 2007, total household debt had reached 130% of disposable income. Families were not accelerating toward prosperity. They were borrowing against futures that had not yet been earned. The Roman historian Livy documented a practice from the early republic called nexum, debt bondage, where an insolvent citizen could be taken into a creditor's service until the obligation was discharged. The Roman Senate abolished nexum in 326 BC, in part because the volume of citizens being bonded for debt was destabilizing the republic itself. The modern American household carries approximately $13,000 in non-mortgage consumer debt. Student loans, auto financing, credit card balances at a current average interest rate of 22.8%. That rate is not a market rate. It is the rate extended to people with no alternative. And every dollar serviced at that rate is a dollar that passed through the financial system before it reached a family's actual life. The economist Thomas Piketty's central argument in Capital in the 21st century rests on a single observation. When the rate of return on capital exceeds the rate of economic growth, inequality compounds automatically. The wealthy accumulate not because they work harder, but because capital by its nature earns more than labor does. The middle class, which earns through wages and holds primarily liabilities, falls behind not through any failure of its own, but through the simple mathematics of the system it inhabits. Act 6. The numbers don't lie. Pew Research Center has tracked the share of American adults living in middle-income households since 1971. In that year, 61% of American adults qualified. By 2023, that figure had fallen to 50%. A majority became a minority over 52 years. The households that exited the middle tier did not all move upward. Roughly equal numbers moved in both directions. The World Inequality Database tracks wealth concentration in real time. In 1980, the bottom 50% of Americans held approximately 4% of national wealth. By 2023, they held 2.3%. The top 1% held 22% in 1980. By 2023, they held 38.7%. The OECD's 2019 report on the squeezed middle class documented this pattern across 20 member countries simultaneously. Middle class households spending a higher share of income on housing, healthcare, and education than at any point in the prior 3 decades, with lower financial buffers than their parents and collapsing confidence that their children will surpass them. Branko Milanovic, the World Bank economist who spent 3 decades mapping the global income distribution, identified the mechanism with precision. The elephant curve of global income growth, which tracks gains by percentile from 1988 to 2008, shows the global poor gaining, the ultra-wealthy gaining enormously, and the developed world middle class gaining almost nothing. The trunk of the elephant reaches skyward for the very top. The body sags everywhere else. Close. Every civilization that has persisted long enough has eventually been forced to answer the same question. What does it owe the people in the middle? The craftsmen, the merchants, the skilled laborers, the cohort that is too prosperous to need charity and too numerous to be ignored. Rome made a calculation. The Gilded Age made a calculation. The post-war West, with its progressive taxation, its union protections, its subsidized housing and GI bills, made a different one, and it produced for roughly 3 decades the largest middle class in human history. That political architecture was then systematically dismantled. The Pew data records what followed. The Roman silver denarius was not debased in a single day. It happened by fractions, a percent of silver replaced by bronze here, another there, until one morning a merchant in Alexandria scratched the coin's surface and watched the silver flake away. The coin still looked like money. It had simply stopped being worth what it claimed to be. If what you just watched felt less like a video and more like reading a document you should have had access to years ago, that's the point. Subscribe. This channel exists to hand you the primary sources. The question is no longer whether the middle class is declining. The data settled that. The question, the one that will define what comes next, is whether the people who benefit from the current architecture have any interest in rebuilding it. History suggests they will not volunteer.